Hello class, I want you to get settled in, get your notes out, because today the lesson that we're going to be going over is how to offset interest costs, okay? And the first thing we're going to tackle first is how to offset interest costs when doing velocity banking, okay? And this will be a three-part series. We're going to do velocity banking, insurance, and we'll hit real estate, okay? So in this example, diving right into it, I listed out two types of debts, right? On the top portion here, we have a simple interest personal line of credit debt of about 5K, right? That's the line of credit limit, is 5 grand. On the bottom portion here, we have an amortized personal loan for 10K. And I listed out both interest rates, right? So on the top portion here, we got 10.99. On the bottom, we got 9.99. This number right here, it would be the monthly payment if they were to owe this much, 5K. Same thing over here, 10K. Here's the monthly payment, $212.42. Here's the interest cost of borrowing money of 10K on an amortized loan. Here would be the monthly interest that would come out of the 212 each and every month, right? And over a 5-year period, right? So this is a 10K personal loan debt for 5 years. Here's the total interest paid, right, which would be $2,745 and a couple cents. Up here, a little bit different. Line of credit for 5K. Here's the interest rate, calculated simple. In 1 year, if all they did was pay $108 a month for 12 months, here would be the interest costs of borrowing this money. $549. Notice the difference, right? If you were to times that by 12, you get a higher number, okay, than $549. Same thing when we're talking with a line of credit, when the interest is calculated simple, okay, it has to get broken down a little bit more as opposed to an amortized. Amortized is pretty simple. There's calculators for it, and you just plug in the numbers and the interest gets calculated on the entirety of the debt. Whereas opposed to a line of credit, it's a little more complicated, but it's actually better in terms of interest costs, right? So when I was saying the 1 year, that's how much that would cost. Well, if they only have 5K out for 1 month, that would be the interest rate, $45 on 108 in a month, about 45 bucks. And per day would be about $1.52 on this monthly payment. Okay? So the reason why I'm explaining these things is when I'm getting asked often, how is it that we're able to borrow money, right, debt, get more debt to try and pay off other debt? How does that make sense, right? And the best way that I can make sense of it is by showing you the math behind the numbers and the interest costs behind the numbers, and also showing you where the offsetting occurs. So let's say in this example that someone owes $10,000 on a loan and they want to learn how to pay it off very, very quickly to avoid paying a lot in interest, right? Now the fastest way, right, would be to obviously apply the velocity banking method, where we're going to get this tool right here, this line of credit for $5,000, and we would make a chunk payment, okay, on the 10. Now, what would happen immediately when I take out $5,000 out of this line of credit? Immediately, I'm going to start paying interest on this debt, as well as I'm already paying interest on this debt. And this is where it can get a little confusing, where, well, how does that make sense, man? Right? Now I'm paying interest in two places, right? So, when we took this 5, we immediately made a chunk on this debt of $5,000. So what would happen, that gets cut in half to about $5,000 or so, right? Okay. But also, this gets cut in half, right? So the interest savings would be a little over $1,000, right? Because I'm no longer going to be paying interest on the whole $10,000, right? Because I made that chunk payment, right? And for the following months moving forward, guess what also happens? This gets cut in half on the 212, right? Because month 1, if I make that chunk payment towards the $10,000, bring it down to 5, satisfy the month's payment, right? But next month, I'm going to have the same 212 owed, correct? I'm still going to owe this next month. I'm still going to have to pay it. But now, instead of paying $80 or so on interest on the 212, that number is going to get cut in half to about $40 or $30 even, right? And this expedites the next payments that I make throughout the year, right? More money is going towards principal, which is paying off the debt much faster. Now, we have to solve for this debt that we just took out, because are we not paying interest that we just took? Yes, we are. But how do we offset it? Right? When I mean offset, which is how do I not pay that interest, right? And save money and increase my cash flow in the process of doing this, right? So, in this scenario, let's say this person has income, they make money, they work at a job, a business, okay? Let's say they make $3,000 a month, okay? Their expenses are $2,500 and their cash flow is $500, okay? So $3,000, $2,500 expense, and then $500 cash flow. Okay? Now, to offset interest costs from accruing on this debt, because in order for the interest to actually accrue, time must go by. Whereas opposed to an amortized debt, no time needs to go by. As soon as you take the debt, as soon as you have this $10,000 owed, no matter if you pay the $212 on the first of the month or the last of the month, you'll still pay the same amount in interest, no matter what. Whereas opposed to a line of credit that's calculated simple interest, it's going to take time for the interest to accrue, to go up, right? So how do we cut that from occurring? And the way we would do that is by dumping or depositing our income of $3,000 into the line of credit. Now, immediately, in the same month that we took the 5 to pay the 10. We're also going to take our income for that month and put it in the line of credit. And we would only pay interest around here or around here, whereas opposed to paying interest up here. Okay? Now, we saved over $1,000 over here. So now we have a cushion. Okay? $1,000 savings over here, just over here alone. $1,000 that we have as cushion to offset this. To make this even better, when we dump our income into the line of credit, our interest costs are going to be somewhere around here, okay, when we make that first $3K chunk right back into the line of credit. But now we also have to solve for our expenses, right? The 25. Okay? So in that same month that we took 5 to pay 10, dump 3 to pay the 5, we have to take $2,500 out, not all at once, little by little, to pay your bills throughout the month. And what happens is your cash flow remains in the line of credit to offset this number right here. See, check this out. As soon as you made that 3K chunk, guess what? You don't have a due date. You won't have a monthly payment for that month. And you won't have a payment for the next 2 to 3 months. It'll get pushed out further. And when you push it out further, guess what? You also push out interest further out. It'll need time. See? It needs time to accrue. Whereas opposed to down here, we don't need time to accrue interest. Day one, it already accrues interest. So notice how time is now on your side when doing velocity banking. Okay? Now get this. This cash flow, times that by 12 months equals $6,000. Okay? So it will take less than 12 months to satisfy the 5K debt that you just took out. That makes sense? Less than 12 months. If we just kept doing dumping 3, taking out 25, leaving 5 in. Right? So at the end of the month, you'll have a balance of 500, right? $500. You'll have a balance of $4,500 or even less. Just depends on when you're withdrawing the money to pay your expenses and then putting the money back in as you get paid throughout the month. So it'll vary, but to be safe, $4,500 will be your balance month 1. Month 2, 4. Month 3, 35. 3, 25. 2, 15,050. As this is occurring, guess what? You're also paying this $212. Right? It's part of your expenses anyway. Right? It's part of your expenses anyway. So the $212 for the next 11 months is also lowering the balance, which is also increasing your savings on interest. Right? Interest. Big savings. So then, year 2, we will only have to make a chunk payment of a few thousand, probably 3 or 4, not even, right? It'll probably be about 3 grand. You'll make the last chunk, which would give you another maybe 400 or 500 bucks in interest savings again. Okay, now you've completely satisfied this entire debt. Done, right? All complete, zeroed out. This 212 is now cash flow. Guess what? As you're satisfying that last chunk on the line of credit for 3 grand or so, it's going to take even a shorter period of time to pay that off. And if it's taking a shorter period of time, guess what? It's taking a shorter interest from you. You're going to stay in this area right here. Right? Very, very little cost right here. And it won't feel like you paid anything. In fact, there'll be times where you do actually pay 0% interest when you're making chunks, right? Of 3 grand each and every month. You're making chunks, whether it's 3,000 all at once, or 1,500, or every week, right? Either way, there'll be times where you actually pay 0% in interest, which also would increase a person's cash flow. Because if I'm not paying interest over here, if I cut it in half, right? If I cut that number in half, I cut the total number in half, I cut this down even less. Now my cost of borrowing becomes nothing, minimal, nothing, right? And in the process, I never lose this, my cash flow, right? I never lose the cash flow. It stays right in this line of credit, or it stays in my checking account. Both, one of the two, right? Pretty interesting, right? How this can really help an individual with their personal finances. So I hope you enjoyed this. Tune in, because I'll be going over velocity banking with other vehicles, right? This vehicle that we used today was a line of credit, all right? In my next vehicle, I'll go over insurance and I'll go over real estate, how to offset interest costs when borrowing money to either pay off debt or acquire assets, one of the two. So I hope you enjoyed that. Thank you very much. My name's Denzel. Have a wonderful day.